Everybody. Yeah. I just wanted to do a quick video just on how to deal with gaps that go against you. And this is going to be literally minutes, but just a way to do it moving forward. So you have some kind of reference point if you ever get caught. This really applies to, excuse me, this really applies to stocks that you're in that you get trapped. Let's say let's say you buy something and then the next morning you wait, it opens up, there's a gap, or you short something, there's a gap. How you could do it. Now, this does not apply to any stock that is part of a takeover. So if there's an announcement about company A is buying company B, excuse me, this is not going to work. Okay. Because this is only for just gaps, regular gaps, the market gaps, everything is gapping with it, as opposed to some kind of news catalyst like a takeover or something of that nature. Okay. So the best way to do this, I have this set to a 5 minute. Let's just set this quickly to a 15 minute. The way you should do it is, let's say, for example, for some oddball reason, for some, not oddball reason, for some reason you got long NVIDIA at the close. You wake up the next morning and there's a gap and the market opens up all the way down here. Let's just say, let's say NVIDIA closed on Thursday at 120. It opened up on Friday at 118. So you had a $2 gap here. Okay. Forget about the dollar amount. This is just for the gap perspective. What you should do is you should wait. So let's just go to a 5 minute, which make it a little bit more dramatic. Don't do this on 1 minute charts because I'm not an advocate of woman. I think that the time frame is too small. I don't really think you should be trading on 1 minute charts to begin with, but that'll be a separate discussion for a later time. Let's say you're on a 5 minute and you see the gap. Like, how do you handle this? So what you should do is wait about 15 minutes. So let's just make this a 15-minute chart for the purposes of this discussion. Okay. Once 15 minutes are established, just put your stop at the low of the day, which is your reference point. So let's say you were long from here, and then the stock, the low for Friday was 116.40 on that 15 minutes. You put your stop at 116.39, 38, or over there, and let it be. Let the stock recover. Okay. Specifically in this one, you would have recovered. Okay. This is a way for you to stay in your trades in a gap without getting hurt. And you know exactly where your risk is now defined. So even if it blows through where your initial stop was going to be, you're now stuck in a gap. So you have a few ways of going about this. You can either dump out of it immediately and then regret that decision half hour later. You could be deer in the headlights, which is never a good thing. And then everything just keeps dumping against you. You don't know what to do with it. Or you can be constructive with your risk, take a step back, which allows you to take a deep breath, survey what's going on in the landscape around you, and then be able to put your stops in places that if you're wrong, even on the day, you're comfortable with it because you've already defined your risk. So now you can allow the stock to either recover, go nowhere, or stop you up, but at least you'll be having your risk defined. That didn't come out right. That way you'll have your risk defined. So again, stock opens up, gaps underneath your price or gaps above your price. Wait 15 minutes, use a 15-minute low, and that's how you should play this. You should play it from from managing your risk. Let's see if we can find another one where you can see a little bit better. That is no good. Well, I'm just going to go through quickly to see if I can find one. I may not be able to find one, so if I can't, I'll what's it called it? Scratch it. Yeah, here's a good one. Let's say you were short this for whatever reason, okay? And the stock gaps up, right? This is a gap, right? So what do you do with this? Again, put your stop at the 15-minute high, and then just let it do what it's going to do. And then maybe either it recovers or it goes nowhere, or you get stopped out, but at least your risk is more defined. Yeah. I'm trying to find one that would be a good one on a gap, which I'm having a little bit of some difficulty with. It's to be that I'm not going to find. Okay. It is what it is. Yeah. Even this one, this Broadcom, let's say you were short Broadcom, right? The stock gaps up. Okay. So, on this 15-minute, let's just go 5 minutes, switch it down for a second. On this 5 minute, right away, it would have worked out in your favor. See, you have the gap over here, the gap over here, up to here, right? So you would basically just wait 15 minutes and then put your stop at the high of the day and use that as your reference point. What you're looking for when you're doing these in general, any trade, you're looking to find reference points, okay? Reference points that you can lean on to allow you to minimize your risk and to just mitigate it. Because that's really all you're trying to do is you're just trying to mitigate your risk when a gap happens. Because again, a gap is not something you can foresee. So this is just a quick way for you to keep your risk in check so that if something does go wrong, you're not panicking. Okay. So let's just go over it again. A stock gaps above, gaps against you, use a 15-minute high or low. So if it means you have to turn your computer off or walk away for 15 minutes, then so be it, because you don't want to act emotional. You want to act in a way that later on, when you've calmed down and cooler heads are prevailing, you can say to yourself, the situation went against me, but I acted in a cool and rational fashion, which allowed me to mitigate my risk. Now, if I was wrong, I'm wrong. It is what it is. But the last thing you want to do if you're short, let's just say you're short, this thing gaps up against you, is puke out of this only to see if you would have waited 15, 20 minutes, you would have recovered and everything would have been fine. Okay. So again, wait 15 minutes, put your stop at either the high of the day or the low of the day, and that's your way of mitigating risk.